Video, my recording capturing cut off at the end of the last part, so we'll just split into two parts, not that big of a deal. So as I was saying, you never want to hold through earnings because going into earnings, you have a lot of uncertainty as to what our stock will go to because usually earnings reports will be either after trading hours end or before trading starts in the morning. So the problem with earnings is even if you have a good earnings report, a lot of investors might feel like they want to sell off and take their profits, knowing they can buy back in at a dip. So after hours, especially, you might have a stock go in. Like for me personally, I have an example. For my example, I had an options call for TTWO in the past, back over the summer, and I held through their earnings, not realizing this rule, and they, even though they crushed earnings, they bombed and the stock went down like $8. You know what I mean? People take profits, and people sometimes earnings reports, even if they're solid, there's an aspect or a facet of them that investors don't particularly like to react to. Like maybe the company drops news for the future and that doesn't answer some questions that investors have as like the direction of the company. That can, I know that happened with Intel recently, so the stock went down. So holding through earnings itself is a gamble, but especially playing the run up to earnings though, is something that I usually do. Like currently in this situation, we have Apple and Microsoft and Nvidia, not Nvidia, Apple and Microsoft who are having earnings run ups where their stocks are increasing in price significantly based on the expected earnings. So at that point, that's what I recommend playing. I usually play the run up to earnings, and but I don't recommend holding for afterwards. The introduction to options. So options. This is a big part of trading. A lot of people usually trade options. Options are essentially contracts that can be bought and sold between two parties. They are a bundle of 100 shares of the company and provide much more potential for significant gains, but also much more risk. So I have some investments, but I also like trading options. I like swing trading options. Basically, as an introduction, we'll just discuss two simple types of options, which are calls and puts. Calls are you are betting the underlying will increase in price, so that you think the stock will increase in price, so you buy a call. Puts, you are betting the underlying will decrease in price, so you think it's going to go down. Premium is the cost you pay to the contract itself, and you want to pay attention to the Greeks. The Greeks are what matter in options. So let's go through right here. So here's an example. Here's Apple. We're using Apple as an example a lot recently. So if you see today, Apple had a very good day. Started off red, rebounded, went down again, and then just ripped afterwards. Had a steady growth upward. So if we try to trade Apple options, we need to keep track of a lot of things. So number one, when you want to get an option, the best thing to do is try to get as far out as possible. So contract expiration date is key because the closer a contract is to expiring, the higher the chance your contract will expire worthless. So the further out you get a contract, the better. So I usually try to shoot for around between 3 weeks to a month. So say someone wants to get a call, so someone thinks the Apple will go up in price for February 19th expiration. And then here we see this option chain right here. So you might be looking at this and thinking, oh, what am I looking at? Like I don't know what to look for. So basically right here, we know Apple's share price is $140.37. So we see when there's a, right here in the first price right here, we have the strike price. So this is the price that you think Apple is going to go up to. So as we can see, Apple's already passed $140. So what does that mean? So that means you want to look at the Greeks right here. The Greeks are one of the main things you want to look at. So delta is basically the value of the contract itself. So this is the premium right here that you're paying. So if I decided to buy this contract, I would have to pay $605 for the contract itself. So I will look at the delta. That's one of the first things I look at. So the delta is basically the value of the increase of the option based on stock. So if Apple goes up $1 and delta is 0.50, the contract itself will go up 50 cents. So we got to remember this is all times 100 because an options contract holds 100 shares. So if Apple goes up to $141.37, that means the price of the contract will go up to $6.55 or $655. So if I bought in at 605 and Apple went up $1, my delta is 0.50, I would add that to the premium, and that's how much my contract would be worth. Okay, so next we're going to look at the gamma. So for the gamma, for every increase in the delta by the share for $1, the gamma will add to the delta. So if Apple goes up by $1, your delta will apply to this options contract. So you'll be worth 655. So for the next dollar, you can add this gamma. So you would add gamma to this delta. So your new delta now would be 0.5245. 0.52. Okay? So that means when Apple goes from 141 to 142, so if Apple goes up another dollar, then your contract is going to go up $52 now instead of just 50, because since Apple's share strike price went up, your contract went up because of delta, but delta also goes up because of gamma. Okay, that's what's important. So basically, so then after that, if Apple goes up another dollar, you would add gamma again to the delta. So then you would have $54 for your delta, and you would add that to your increase in the premium. So next we need to keep track of, this is very important, is theta. Theta is basically the decay of the contract. Think of if you're familiar with chemistry, it's similar to half-life of an atom. The closer you get to an expiration of a contract, the higher the theta. It's basically, it eats away at the value of your contract. So you want to keep your theta as low as possible. So for these February 19th costs, we can see that theta is negative 0.1160. So that means for every day that you hold this contract, it will lose $11.60 in value. So say even if you hold it for 5 days and you make a profit, your value will have decreased over time because of theta. And for each day that your contract gets closer to expiration, your theta increases exponentially. So it's kind of like an exponential graph. You're gonna have theta, and it's gonna have a sharp increase as your expiration date gets closer. As an example, let's look at these contracts right here for January 29th. So if we wanted to get a $140 call for January 29th, notice how the premium is cheaper. The premium is cheaper because we have less time to reach our goal of maximizing profit. But if you look at the theta right here, the theta is negative 0.3153. So you're losing $31.53 worth of your contract each day you hold based on the theta. And tomorrow, the theta is going to open up even higher because there's an exponential increase. Okay. So those are the main ones that matter. Rho we don't really have to look at anymore, and Vega has to do with implied volatility, so that's not as important. It basically measures the options price sensitivity to the changes in underlying volatility, so it does matter if you have a high implied volatility. So we see for these contracts they have low implied volatility, so that means there's a more of an assured direction that the company is going. A company that has a high implied volatility right now is GameStop. So as we can see right here, GameStop went opened at $43 and went as high as $73. So if we want to get an option for GameStop, you check this price, the implied volatility is 267%. So the higher the implied volatility, the more concerning it is for buyers, because you can be subject to an IV crush, as we call it. So an IV crush essentially is, even if you buy this call and the GameStop does go up in price, your implied volatility is going to decrease because you have an increasingly clear vision of where the stock is going. So right now, there's an uncertainty of if GameStop is going to keep rising to 70 plus again, or if it's going to go down to 50, like 50 plus. So because of this uncertainty, your implied volatility is high. So once the stock starts going in a certain direction, its implied volatility will decrease. Therefore, if you have a severe decrease in implied volatility, the worth of your contract will actually decrease as well. That's why it's called an IV crush. So that's why I want to stay away from options with high implied volatility, because even if I got this call and the stock went up, the value of my contract can actually go down because of the implied volatility decreasing. So the bid ask, I like to look at that too. The bid is the price that buyers are willing to buy it at, and the ask is what sellers are trying to sell it for. The tighter the bid ask, the better it is, because you will get filled in at an optimal price. You have the volume, the higher the volume, the better. Sometimes contracts, even if they look good, if there's no volume in them, it'll be very difficult to sell them, so you might not make as much money. We talked about open interest. That's how many contracts are open. The low is the low of a contract. The high is the highest it reached. So this contract, In the previous close is how much that contract was worth the day before. So say if I got this contract yesterday right before closing, I would have got it for $103. And if I sold it for a high today, I could have sold it for $2,280, as an example. Um, yeah, that's the Greeks and that's the basics of options. So how do you determine good option plays? So the key to determining what a good option play is involves combining technical analysis and fundamental analysis with catalysts. So technical analysis is when you analyze charts and their movements to determine which direction a stock will go. So what I personally use, my apologies, I use TD Ameritrade and their charting for their charting platform Thinkorswim. So this is what Thinkorswim looks like. So basically, technical analysis involves looking at this chart and utilizing methods such as chart patterns, volume, support, resistance. You combine all of those together to determine where you think the stock is going to go. So for RK, so this is an ETF, so I want to talk about this too. So when you're looking at ARKs in general and you want to choose to invest, you can see that this has been constantly going up. Even when it does have dips, it quickly recaptures them and it keeps increasing in price. So if you are looking to be more of a long-term investor and you like ETFs, this is why I recommend ARKs ETFs, because they outperform the market a lot more than like the SPY index does, and they're more centered in innovation and disruptive companies, which is what the future is technically going to hold. But one example of a company that actually has a chart pattern is PLTR. So ignore these red lines. So these red lines are essentially what I use for support and resistance. This is called Fibonacci retracements and extensions. So I use Fibonacci sequences because for me it offers a more accurate view of where a stock is going to find support and where it's going to bounce back. I also use this blue line. This is the 200 MA. This is the moving average. So this basically finds the moving average of the price for the past 200 days. So if the stock is above it, it indicates bullish signal. If it's below it, it indicates bearish. Down here I use TMO momentum. And TTM waves. So this basically tells me the momentum of a stock, and when it's trading, if it's in the red zone, that means it's overbought. Too many people have bought it, there will be selling. And if it's in the green, that means it's oversold. So that means there's a lot more people selling, so that means more people will buy it. So one reason I like Palantir is because combining Fibonacci, so combining support and resistance with momentum, with the moving average, and with chart patterns. If we draw in a pattern right here, it might not be quite easy to spot for some people, but we can actually draw in right here and see that there's a bullish pennant that formed. So bullish pennant is a chart pattern that essentially is bullish, meaning if you see this forming, that means the stock will most likely go up. And today we saw it did. The stock went from a low of 25 and finished above $32. So if you did have an option contract right there, you would make a decent amount of money. So right here as my resistance, I have 33.75. So I think that Palantir is going to go up to around this level before we see a bounce back down to around $28 as support. And if it doesn't hold that, it's going to go down to $24 as support. So this is basically just an example of technical analysis and what I use to determine how I use charts to determine what plays I want to make in terms of swing trades. Fundamental analysis. I also like using fundamental analysis to have an overview of the company, determine the strength of a company. So I have an example right here. I misspelled analysis. That's embarrassing. So ROCH. This is a SPAC and it's merging with Pure Cycle Technologies. So I made this on the fly. So essentially, what I do for fundamental analysis is that I provide a thesis. So I provide a statement on why I think the stock is good and what I think is going to happen, and then I provide an overview, and then I go through its financials, its documents, and all that. So as sort of a brief overview, I kind of right here talked about what the merger. So it's merging with Pure Cycle Technologies. So I kind of talked about what they do, how they're going to have an impact in the future. I'm actually very bullish on this stock overall, and I think this is a great long-term hold. I alerted it around $15 as a buy. It's around $20 now, and I think it's going to keep going up. So I provided an explanation as to what they do, where we could see change that are coming, some articles that I can go back to and reread. Um, how I think this is gonna be used in electric vehicles, the customers of PureCycle, and then I would go on further and look at its financial documents and like sort of review its earnings, how they've done, if they have any debt they have to clear. So I would kind of take that all into account. I don't use fundamental analysis as much for options. I do use it for investing though. So I know I used it for Nano Dimension and NDM. That's one of my biggest positions in my portfolio. Um, they're a company that have a bunch of cash on hand and have no debt because they've done offerings. And essentially, what an offering is when a company will provide more shares, so they'll create more share. Well, a dilutive offering is they'll create more shares and sell it to either a specific customer or to the general public. They typically do that to raise cash and raise money. Um, so whenever you see a company do an offering, that's something to consider when you want to invest in them because you got to look at what they're using it for. Are they using it to clear debt? Are they using it to buy another company? What are they using it for? So these are all important aspects. And then you want to consider catalysts too. So like events coming up for the company, like maybe they have a bio conference coming up, or maybe they have earnings coming up. And then you want to look at the news cycle in general. So if Biden came out tomorrow and said that he was going to increase tariffs, that would be bad for the stock market. We would see a decrease. So then you want to consider rotating into a cash heavy position so you can enter in on cheaper entry points. Or if maybe we had Janet Yellen, she's the incoming Treasury Secretary, come in and she said interest rates are going to remain low. That's good for the market. It's very bullish because lower interest rates means higher buying pressure from institutions and retail investors. Now, making your ideal plan. I highly recommend you do not trade options unless you have your own plan. This can include making criteria that the stock has to meet before you enter, your target percentage for gain realization, target percentage to cut a losing contract, etc. Kind of like what I have set up. And the big way to make your ideal plan, I think, is for paper trading. Um, the market we're in right now is it's very unstable market, and it's one that we haven't seen in a while. We could see a reversal coming soon, so I recommend paper trading. That way you can play with sort of fake money. I know TD Ameritrade offers paper trading with that charting analysis, like Thinkorswim charting that I use. By paper trading, you can make certain plays, fine tune your plan, and see how your plays would have planned out. And you can gain some discipline. And then by that, you can determine the kind of trader you want to become, or if you want to just become an investor. And then by then, you can perfect your investing approach as to how you approach a company to invest in, buy, purchase, and all that. So some last thoughts. This is this presentation was merely an intro to the market. It's an oversimplification that leaves nuance out, but it's a good base to start on, and I recommend um, sort of considering all these notes before you start your stock market career. I did sort of go into a little more in-depth things about like charting and stuff. So if that confused you, don't get scared or anything. That's something that I can explain to people personally if they have any questions. I linked some sites and YouTubers I studied from. I use Investopedia.com a lot. They break down almost everything about the market. Rainer Teo on YouTube. I learned a lot of charting stuff from him. I also have some videos for charting analysis, like Fibonacci and TMO momentum and all that. I have videos that of what I specifically used to learn from. So if you need the links to those, I can send that to you if you're interested. And then freetradingmovement.com is a website recently started by Champion Vibe on YouTube. He's a great YouTuber. I definitely recommend checking him out. And that provides a lot of resources. And as always, feel free to ask any questions. I will answer them to the best of my abilities. If there's anything that you felt confused on or want clarification, just let me know. And if there's anything you want me to sort of go in depth more on, let me know about that as well. But good luck to everyone, and thank you.